Something unusual happened when Andy Burnham announced his path back to Parliament on Thursday evening. UK gilt yields did not merely tick higher, they surged to levels last seen under Gordon Brown. The 30-year gilt yield hit 5.84%, a 28-year intraday high, and the 10-year broke above 5.17%, its highest since 2008. The pound shed 0.3% against the dollar to 1.336, extending a weekly loss of 1.5%. That reaction is disproportionate to one politician announcing a by-election candidacy. The mechanism underneath is what the headline misses. Bond markets were not pricing in Burnham winning or even becoming party leader. They were pricing in a prolonged period of UK political disorder with no clear resolution timeline, and a latent risk that a successor government would abandon the fiscal rules the Starmer administration had staked its credibility on. Burnham's own words from a New Statesman interview last year, in which he said the government had to get beyond this thing of being in hock to the bond markets, supplied the market with a directional signal it could price immediately. Capital exited gilts on this signal. Price action indicates the move was led by international holders of long-dated debt, not domestic institutional rotation. The spread widening at the 30-year end was steeper than the 10-year, which is the signature of foreign net selling rather than domestic duration adjustment. Utilities, whose equity valuations are structurally inverse to gilt yields, absorbed the heaviest FTSE 100 losses. United Utilities fell 5.9%, Severn Trent 5.9%, National Grid 5.5%. That sector-level co-movement was not random. It was the mechanical translation of a 14 basis point gilt yield move into equity duration risk. Centrica added a separate drag after agreeing to pay £20 million into Ofgem's redress fund over the British gas prepayment meter scandal, compounding the utilities rout. The FTSE 100 fell 1.7% overall, but the distribution matters. Miners, also hard hit, were tracking a different variable, falling commodity prices, not gilts. The political channel was concentrated precisely in yield-sensitive sectors, and the pound's decline confirmed the sovereign risk framing rather than a generalized risk-off move. But the political story alone does not explain why gilt yields could not stabilize even after the FTSE move was fully absorbed.
The gilt sell-off would be containable if it existed in isolation. It does not. Gilt yields are rising into a dollar that is simultaneously strengthening for a completely different reason, and the collision of those two forces is what makes sterling's position structurally weaker than any single UK political reading would suggest. The dollar gained for a fifth consecutive day on Friday, on pace for its largest weekly rise in 2 months. The driver is not dollar strength in the conventional sense. U.S. 10-year Treasury yields hit 4.58%, their highest in a year after a run of economic data, retail sales, jobless claims, that showed the U.S. economy absorbing the Iran war energy shock better than expected. Markets have now repriced the probability of a Federal Reserve rate hike at its December meeting to 48.4%, up from 14.3% just 1 week ago. Brent crude at $108.60 and WTI at $104.28 are the transmission mechanism. Oil prices elevated by the Strait of Hormuz disruption are not just an energy cost, they are an inflation input that the bond market is treating as a structural reset, not a temporary spike. The implication for sterling is direct. GBP USD is under pressure from both ends of the rate equation. UK political risk widens the UK rate spread in the wrong direction by raising the risk premium on gilts without implying tighter policy, while US rate hike expectations push the dollar up regardless of what the Bank of England does. That is a rare configuration. Sterling typically weakens against the dollar when UK rates fall relative to US rates, but here UK rates are rising too, for political rather than monetary policy reasons. The market is treating the UK sovereign curve and the Fed curve as entirely decoupled, which means GBP cannot use gilt yield rises as a stabilizing argument. Strategist Seth Jeffreys noted that the fear of a more left-leaning successor government increasing the UK fiscal deficit is adding a second layer of sovereign discount to sterling. XTB's Kathleen Brooks placed the pound 1.5% lower for the week and noted that the sell-off was sharpest after Burnham's announcement rather than after Wes Streeting's resignation the previous day, distinguishing between cabinet instability, which markets can absorb, and leadership succession risk, which they apparently cannot. That distinction is where the verification question sits. If the pound's decline is being driven primarily by fiscal succession risk, then a credible candidate with documented fiscal discipline entering the race should arrest the move, even before any formal leadership contest begins. The 30-year gilt yield staying above 5.80% overnight would indicate the fiscal risk premium is still widening, not stabilizing.
There is a third variable in the FTSE picture that runs against the political narrative. At the same time gilts were selling off and the pound was falling, Hiscox surged 15.3% to an all-time high of $18.90. The cause was a report in Insurance Post that Canada's Intact Financial is exploring a potential takeover of the Lloyd's of London insurer. The Hiscox move is not merely a single stock event. It is the third major foreign takeover approach to a UK-listed company in 48 hours. Tate and Lyle confirmed receipt of a £2.7 billion bid from US rival Ingredient the previous day. Its shares rose 45%. Intertek said it was minded to recommend a £10.6 billion Swedish private equity offer from EQT. The pattern being established is that foreign acquirers are systematically using the UK's political discount to buy listed assets at compressed valuations. A falling pound makes that arbitrage cheaper in foreign currency terms, and a prolonged period of political uncertainty that suppresses domestic equity risk appetite creates a structural window for inbound M&A. Capital flow in the Hiscox case was unambiguous in direction. Domestic sellers, who priced the stock at pre-announcement levels reflecting UK valuation compression, were absorbed by foreign-aligned buying. Institutional buyers who had been tracking the discount to international insurance sector peers and needed a catalyst. The reported Intact interest provided that catalyst. Intact's chief executive has previously commented positively on Hiscox commercial lines quality, which means the move is not opportunistic or distressed. It is a strategic premium being paid against a domestically suppressed baseline price. The irony of the configuration is structural. Sterling weakness and gilt instability, driven by political risk, are simultaneously depressing the UK equity base and making UK assets cheaper to foreign acquirers in their own currencies. If the political discount persists, the M&A window widens further. The FTSE 100 fell 1.7% on the day that Hiscox hit an all-time high, which is not a contradiction but a mechanism. The same UK political pressure that compresses the aggregate index is creating individual assets whose discount to international peers becomes too wide to ignore. The question that the next several sessions will answer is whether the Burnham by-election outcome resolves enough uncertainty to close that window, or whether the M&A cycle accelerates while the discount remains. If Hiscox trades above an £18 through the week, the bid speculation is being treated as credible, not speculative, and the compression trade thesis holds. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.